Hello folks, this is Abhinay Gupta from Wikipedia World and I welcome you to today's topic on the accounts of companies. So in our previous lecture we had dealt with section 137 of the Companies Act 2013, which talked about the filing of the financial statement and other documents with the ROC. So today we take up the new topic about section 138, the internal audit. Right friends? So to start with internal audit, the first and foremost thing that we see will be the applicability of internal audit. As per our previous act, that was Companies Act 1956, internal audit was not a mandate. But Companies Act 2013 mandates it for some of the specific companies on the fulfillment of certain criteria. So that will be the applicability part of section 138. So now if we get into the topic, we'll see the companies which are required to appoint an internal auditor. Right? So we will divide the companies into three basic categories. One is the listed public company. So the section 138 says that every listed public company will be required to appoint an internal auditor and perform the internal audit of the company, internal audit of all the components of the company. Right? So the first thing is every listed company. To move on, we'll see what does the act say, what does the section say about the unlisted companies. So if we talk about the unlisted public companies, to be specific, we'll divide it into two categories: unlisted public companies and private companies. So unlisted public companies, in case of the unlisted public companies, the government says, or the act section 138 says that if the company, any public company, fulfills or qualifies the four basic conditions that has been listed down by section 138, the criteria, the limits, if they exceed the limit, they will be required to appoint an internal auditor. So in case of the unlisted public company, they have to qualify certain criteria. Now let us see what those criteria are. The first thing, that the outstanding deposits of the company, of the unlisted public company, should be a minimum of rupees 25 crore. So if the outstanding deposits, the deposits that are outstanding at the end of the year at the balance sheet date, if it exceeds or is equal to 25 crores, then that unlisted public company will be required to appoint an internal auditor. Secondly, if this condition is or is not fulfilled, they will check the next condition. So all the four conditions are of the OR category, right? There won't be a clubbing of any of the two requirements, that this and this. So it's all mutually exclusive. If any one of them is qualified, it's not actually mutually exclusive, because 2-3 conditions can be satisfied, but the occurrence of any one will be enough to make that company fall into the category of internal auditing. The second thing is, if the company has a paid up share capital of greater than equal to rupees 50 crore. So the share capital of the company exceeds 50 crores, then that company will have to appoint an internal auditor. Third thing is the borrowing. If the borrowings of the company throughout the year, or the outstanding loan at the end of the year, exceeds rupees 100 crore, that means it's a big company. So if they're borrowing so much money, then that has to be accounted for. So the company needs to appoint an internal auditor to check, to look into the matter and to audit, to check the controls, the internal controls. Because it is the critical aspect. Now if they're borrowing 100 crores, that means the company is large enough, they have large functions, and to monitor that function, they have to have an internal auditor. And the fourth and the final point would be the turnover. If the company is big enough to earn a turnover of 200 crore per annum or in the financial year, that means that company is working great. That means that company is working on a very large scale. And to manage that large scale, the company needs to appoint an internal auditor who will look into the matters, look into the internal controls, right, of all various segments and departments of the company. So far we have seen two categories, the listed company, all listed companies. right? The listed companies, those have their share capital issued in the market, all of them will have to mandatorily appoint an internal auditor, right? And in case of unlisted public companies, the unlisted companies will be divided into two categories, public and private. So in case of private companies, we have seen the 4 basic conditions, and it is very simple to remember. It just doubles itself. The numbers serially doubles. So when we talk about deposit, it's 25. Doubling it, 50 crore is the limit for the paid up share capital. Doubling it, 100 crore is the limit for the borrowings, and doubling it, 200 crore is the limit for the turnover. And then now the third and the final category, that is the unlisted companies. Into the category of unlisted company will be the private company. So since the conditions that we have seen in the unlisted public companies about the outstanding deposit, paid up share capital, borrowing and turnover, you will have to just qualify the 2 conditions. So the 2 conditions of outstanding deposit and paid up share capital stands null and void. All we need to worry about is the borrowing and turnover in case of the private company, and the limits remain the same. So if the borrowing or the outstanding loan of a private company is more than or equal to 100 crore, it will have to appoint an internal auditor. And if the turnover exceeds 200 crore, they'll have to appoint an internal auditor, right? So this will be the applicability of the internal auditor. What are the companies and in what circumstance, like what is the performance level beyond which the company will need to appoint an internal auditor, right? And this is the requirement of section 138 of the Companies Act 2013. And mark my words, these were not a mandate in your previous act. So it's a new thing, the new concept coming up, a new mandate as per the new act. So this may be very important from your exam point of view too. So moving ahead, we see the legal requirements. Now there are certain legal requirements when you talk about internal audit. So let us see what they are. First thing is the appointment of an internal auditor. So section 138 says when you qualify the limits that we have discussed in the previous slide, you will have to appoint an internal auditor. And then that internal auditor will have to conduct the internal audit for all the functions. Even that is a legal requirement. It is not that you just appoint an auditor and he's sitting in your office and doing some other work, helping you out around something else. No, that internal auditor will have to perform the internal audit functions. They'll have to generate their report. They'll have to check the internal controls, all the controls over all the departments. They have to perform the entire audit throughout the year, right? The exact process of the internal audit has to be performed. That the person who has been hired will be hired in the capacity of an internal auditor for the company. Now, who can be the internal auditor? Like, what are the qualifications required? So any chartered accountant, whether or not in practice, the degree is important. Your COP is not very important. If the accountant doesn't have a certificate of practice and is not practicing but is employed somewhere, or even if they're employed by the same company, they can be an internal auditor for the same company, right? So first thing is you have to be a chartered accountant, and if you are not a chartered accountant, you can be a cost accountant. Even if you're a cost accountant, you qualify to be the internal auditor of the company. And in other circumstances also, there can be other professionals that the board decide to be the internal auditor. So the decision is left at the discretion of the board. If the board of directors deem fit to appoint any other professional to be the internal auditor of the company, the act or the section 138 has no objection for the same, right? But in general, what you appoint is a chartered accountant or a cost accountant, largely a chartered accountant, right? Then the internal auditor may also be an employee. This is an important point because that can be a case study for your examination. Mr. X was appointed as the internal auditor. Mr. X was a chartered accountant. The company fulfills all the limit, and Mr. X was also the employee of the company, right? And then you'll have to say whether or not they have been in compliance with section 138. So in that case, you will have to jot down all the points. Okay, these were the limits, the applicability, the criteria that if you fulfill, you'll have to appoint an internal auditor. So if they are fulfilled, now the internal auditor will have to be a chartered accountant or a cost accountant or other qualified person as decided by the board. And they can also be the employee of the company. So hence the company is not at fault and they can do the same. And these were the provisions of section 138 of Companies Act 2013. So it will be a simple question like that. So you will have to actually understand where the requirement of the internal auditor comes into play, right? And what are the legal requirements behind that? It is very simple. It's a small topic. It's just two, three points that you had to understand, and then it's clear, right? So let's move ahead with this. So moving ahead, we see the manner and the interval of internal audit. So how do you conduct an internal audit? Who will direct it? So the Act says that the central government may by any rule prescribe the manner, and they may also by passing the rule prescribe the intervals, right, in which the internal audit should be conducted. So it is not a notification in the official gazette. They will have to pass a rule, right? A rule which will be supplementary to the complementary to the Act. And the scope, the functioning, periodicity, and the methodology of conducting the internal audit will be decided by the internal auditor himself, but in consultation with the audit committee that the board of directors have created. So we have already seen the provisions for the audit committee. There have to be 3 directors, one of them have to be independent and stuff. So that has already been discussed in the previous lectures. So I think it is very clear with you what audit committee is. Over here, all we have to refer the audit committee for is to decide and formulate the scope, the functioning, the periodicity, and the methodology of performing an internal audit, right? The next is the legal requirement for the existing companies, right? So all the companies that were existent when the Act became applicable, so if they satisfy any of the criteria laid down in Rule 13, right, that is if they fall under the prescribed class of companies for the purpose of Section 138, like if they are required by the Act to appoint an internal auditor, but so far they had not been doing so, because as I have already told you, Companies Act 1956 had no such mandate requirement, right? So if there is a company who has already been qualifying these criterias but had no internal auditor in the past, and now the Act 2013 comes into play, so they will have to comply with the provision of Section 138 within 6 months, right? They'll have to comply with both the provisions of 138 and Rule 13 within 6 months of its applicability, right? So internal audit is an important topic for you. There are few basic points, the 4 basic points that you need to remember. It is not very much in detail. It is not at all difficult. But yeah, you can be asked a case study question on this, and you will have to reply to that answer point to point. You will have to jot down the limits. You will have to jot down the requirements of the section, right? So moving ahead, we see the revision of the account. The accounts that the board of directors have prepared, the financials that they have prepared at the year end, can they be revised? Okay? It's a simple question. So the revision can be at 2 times. One is before circulation to the shareholders, and the other is after circulation to the shareholders. So unless and until the accounts are shared with the shareholders, it remains with the board of directors and the auditor, right? So at that point of time, it becomes a little easier to revise an account. So until the accounts have been circulated to the shareholders, the board is empowered to revise the account and resubmit them to the auditor, right? And that is the requirement that was given by the guidance note on auditor's report, right? It was a circulation issued by ICAI. So according to it, if you want to revise it before circulation, you can do so, and you can resubmit it to the auditors, right? But that will be subject to certain conditions, right? That can be done subject to the fulfillment of certain conditions. Now we need to see what those conditions are. So we have already discussed it, but if we put it down into points, there are 4 basic points that we need to consider. The first is that they should not have been circulated to the shareholders, right, or placed in the annual general meeting of the shareholders. Second, that the auditor's report on the revised account should be given in substitution to the earlier auditor's report. Because since you had already given the financials to the auditor and auditors have given their report, now you revise the account. So the auditor will have to give a new report, and that will be in substitution to the old report. So the old report will stand null and void and cancelled, right? And then you will have to give an adequate disclosure regarding the revision of the account in your report. The board will have to do that in their report, right? They'll have to mention that, yeah, we have revised the account due to such and such reason, and they'll have to justify it. And same thing will have to be done by the auditor too. The auditor in his auditor's report will have to mention specifically that they have given a revised audit report on the basis of the revised account, right? So these are the basic 4 criteria, right? That you'll have, that it can be done before circulation, auditor's report will be a substitution, and they'll have to specify it in their board report and the auditor's report. Now what are the conditions? What will happen when the revision and is it allowed to revise after adoption or circulation to the shareholders? Will that be possible? So this point is taken up by your Ministry of Corporate Affairs, which was earlier known as the Department of Companies Affairs. So this issue began somewhere back in 1981. Right? In 1981, it was a clear mandate by the Ministry of Corporate Affairs that the accounts that have already been adopted in the annual general meeting will not be reopened in the subsequent meeting. Once it has been disclosed over there, it has to be closed. You cannot reopen or revise the accounts. That was a rule passed by the ministry back in 1981. That was the time it prevailed. But then this rule went into some modifications. So moving ahead, in 1986, the Ministry of Corporate Affairs allowed the revision for some specific purpose. They say that, yeah, it can be revised for meeting the technical requirements of the taxation law only, right? So this was a statement. If you do it for meeting the technical requirement of the taxation law, you can revise the account. That is the only condition when you could do so. And this was the rule prevailing in 1986. And then again, they had to consider this position for insurance companies pursuant to the direction given by the IRDA. IRDA is the Insurance Regulatory and Development Authority. So they had given some rules, they had passed some rules and laws, and the insurance company had to abide by the same. And for that, there were insurance companies who had to revise their account even after they had been submitted or adopted by the shareholders in the general meeting. So again, that was the time when new amendments came in and they took the position. So finally, the department passed on a circular in the year 2003, to be specific, 13th January 2003. And then it was said, it was little modified, and instead of the taxation law, they put in a word, any other law, right? So they said that in order to comply with the technical requirements of any other law, and that was to achieve the object of exhibiting true and fair view of the financial statement. If that was the condition, then it could be done. It could be revised. And where would it be revised? It would be revised in the it will be revised after the annual general meeting, and the revised account would be required to be adopted either in the extraordinary general meeting called for that purpose or in the subsequent annual general meeting, and then it had to be filed with the registrar. So starting from 1981, it went under a change soon after in 1986, and then for a long time that prevailed after the IRDA Act, and then after the issue of the IRDA, and then the Act was again amended. The circular was passed by the Department of Companies Affairs, now known as the Ministry of Corporate Affairs, that it could be due to the change in any law, and that was to be done for bringing the true and fair view out in the financial statement. So these were the conditions that were taken ahead. So I think the class was useful to you, and so far with this class we come to an end of the chapter Accounts of Companies, right? So we have discussed all the sections, beginning with section 128 and ending with section 138, and in between there were few unimportant sections too, section 130, 131, 132, but even we discussed about that in a very little brief, and that was the only part out of which you could be asked question in your examination. And moving ahead, we did section 136, 137, 138 about internal audit and stuff, and the revision of account. So with this we come to the end of the chapter. This is Abhinay Gupta thanking you so much for your presence and cooperation. And so with this I'll be signing off for the day. Thank you.